Hi there, thanks for joining us here at PhillipCapital Market Watch. I'm Jin Ru from Phillip Futures. Today, we will be discussing the topic Trade War Escalations. How severe are the repercussions? Firstly, let's recap the series of events leading up till today. The first wave of tariffs was implemented approximately 13 months ago. Soon after, two more waves of tariffs were enacted in August and September 2018. While there were brief cooling off periods between both countries, things started heating up again when President Trump announced new waves of tariffs on the 13th of August 2018. There are various negative repercussions of a prolonged trade war, namely, a global economic slowdown, enhanced market volatility, disruptions in the global supply chain, and the risk of worsening political tensions leading to currency wars. Real GDP and retail sales figures have fallen across the board. This implies rapidly decreasing consumer confidence and cooling economic growth. While the unemployment rate has not increased much, we do expect the situation to go downhill once the tariffs are successfully implemented and global demand falters as a result. Market volatility has been greatly enhanced. We see that both US and Asian equities have been free falling since President Trump announced on 1st August 2019 that he will impose a 10% tariff on 300 billion of Chinese goods. Investors are increasingly pessimistic that both parties will resolve their differences in the short term. Instead, investors have been rushing into safer assets, such as gold, a traditional safe haven asset. It successfully broke the 1,500 barrier and has consistently traded above the previous resistance within the past month. The demand for safe assets is also apparent from the dip in 30-year yields. It has fallen from 2.44% on the 1st of August 2019 to 2.07% on the 22nd of August 2019. The global supply chains have been widely disrupted, with manufacturers moving production lines to other Southeast Asian countries such as Vietnam and Malaysia. Chinese firms are also actively innovating new proprietary technologies and moving their reliance away from Western technologies and parts. Ultimately, the tariff costs are borne by the final consumers, who will end up paying for products that could be of lower quality. The People's Bank of China has been gradually weakening the yuan through rate fixing every day since Trump announced the fresh wave of tariffs. We believe that competitive devaluation is not likely to happen, as the Chinese are keen on promoting the yuan as an international currency. However, the Trump administration's move to label it as a currency manipulator could trigger retaliation. Thus, although the possibility of a currency war occurring remains low, we should remain vigilant. In summary, we believe that a prolonged trade war is detrimental to global growth. Though it is hardly the cause of the global economic slowdown, it has been exacerbating the pace of it. GDP, retail sales, exports, and corporate earnings are likely to worsen at a faster pace than initially expected. However, there's some light at the end of the tunnel. As supply chains are being restructured, the frictional costs remain high during the initial stages. We expect most economies to recover once manufacturers successfully set up new production lines in other cheaper, resource-rich countries. That's all for PhillipCapital's Market Watch. Do remember to follow us on social media and subscribe to our YouTube channel. Also, tell us what you think. Do you think that the trade war would cause severe and lasting damage to the world economy? Leave your comments. Thanks for joining us and see you soon.